Hello, everyone. Thank you very much for joining today's webinar. Just while we wait for the numbers to settle, my colleague Ruth, who's joining me today, who's our head of marketing, has just put up a poll. We're just trying to get a gauge from those of you that may be affected by the topic today, which is called auto enrolment. This is the new government pension scheme that's going to really transform pensions in Ireland and is going to take effect towards the very back end of this year. So just while we're waiting for one or two people to join, if you could just fill in the poll. I see that most of you do have a pension scheme currently that have responded, but there are one or two of you that haven't. And as I said, hopefully there will be some takeaways from today, not just in the pensions environment. I'm going to try and talk a little bit more about some of the other things that we should be looking at from a point of view of our own personal finances. I'm going to take the next 25 to 30 minutes just to go through things. We try to make these sessions as interactive as possible. So if anyone does have any questions, if you could just pop them into the chat. And my colleague Ruth, who's assisted by another of our colleagues, Kerry, will be just basically responding to that. And we are available for any queries or questions. Some of you, I'm conscious, may have listened to the previous auto enrollment webinar that we ran in January. There are some very important updates, which is why we felt it was important to do a session. For those of you listening live, I'm conscious it's the day before the Easter break, so I do appreciate you taking the time to listen in. And obviously this is recorded and we are looking to provide further updates as the year progresses. Just for those of you that are not familiar with Alpha Wealth, we're a progressive financial services company based primarily in Cork. We do have a small presence in Dublin. There's 10 qualified advisors in Alpha Wealth, and we are looking to expand further. We've just brought in 2 people in addition to the existing team. So to get to the crux of it, what is auto enrollment and why should you take any interest in this? Well, this is going to affect any company owners that employ people. It's going to affect any employees that are in a company that do not presently have or have joined their company pension scheme. And on the slide here, which hopefully you can see, states that the date we now know looks like the 1st of January 2025. This was passed through the Dáil earlier this week. Minister Humphreys, who's, believe it or not, the 9th minister since auto enrolment was first mentioned in Ireland 20 years ago, has been very vehement about ensuring that this will happen this year. And as I said, it looks like whilst it will fall into 2025, it's going to go live on the 1st of January. And I think it's really important for anyone listening to this call who, as I said, is a company owner who employs more than one person, or indeed is an employee that isn't part of a pension scheme. They really need to take action this year. We're looking at obviously helping companies budget and indeed employees, and why it's so important to act now.
Hi, Nick. Sorry, just to interrupt you there. Someone just dropped in a really quick question. They asked, what if I'm already in a pension scheme?
So really it depends on whether or not the company are paying into the pension for you, because if they're not, and let's say you're paying into your pension scheme through what's called a PRSA, which is the current vehicle that's available for employees where the company doesn't pay into the pension. And by the way, the scope is going to be really large. We believe that this is going to affect about 800,000 people in Ireland. But the point being is that if your company's not paying into the pension scheme, you will be auto-enrolled, because the point of the auto-enrollment is that your company will have to pay a minimum of 1.5% of your salary. And therefore, it's advantageous for you as an employee. So what you'd have is you'd effectively end up with 2 pensions. You'd stop paying into your existing scheme, and then obviously you'd have a new arrangement, hopefully paid for directly by your employer into the scheme of your choice. If it's a company paid scheme, then this doesn't affect you and you can just continue on as long as the contributions are at 1.5% or higher. And again, if anyone would like to ask any further questions, please do put them into the chat. We do want to make sure that we are addressing things. I just want to make reference to some of the recent coverage that we've had, not just on auto enrolment, but also in relation to other areas that Alpha Wealth provides advice in, including mortgages. I did a recent webinar on what's called the FIRE movement. This is helping people to effectively reach financial independence at the earlier stage, generally from 60 or earlier. I'm going to touch on this later on because it's relevant to the whole area of long-term planning, but I'm also going to touch on one or two other areas. And I would encourage anybody, if they are looking to maybe get some kind of financial advice or education, maybe go onto the Alpha Wealth website. There's some really good webinars that David Looney, my fellow financial advisor colleague, and myself have ran over the last few months. David is going to be running a session on the 18th of April. I'm going to mention it later in this, and I really would encourage anybody who's listening to log on to that. So coming back to auto enrolment, Minister Humphreys said on the 1st of February, and it's all over the news today for anyone who is listening live on the 28th of March, that the government are absolutely serious. And a lot of people didn't believe that auto enrolment would happen this year, and yet it looks like it's just been passed, as I said in the Doyle. What is auto enrolment? How significant is it? Well, as I said, it's going to affect about 800,000 people, particularly in industries where there's generally not a company pension contribution in play. What does it mean? It means basically for every €3 that the employee pays in, and there is a requirement, unlike Australia, where auto enrolment was introduced 30 years ago, where there's no compulsion on the employee. In the Irish auto enrolment scheme, there is a requirement, but for every €3, 3 more is added by the employer and 1 is then added by the state. Not particularly attractive, certainly for those people who are paying tax at the high rate, earning over 42,000 a year. The starting point will be 1.5% of salary, which might sound relatively low, but it's going to be increased fairly significantly over a 9-year period, up to 6%. And then
Sorry, Nick, sorry, just to interrupt you there. Someone just dropped in a question in relation to that slide. In relation to the proposed €1 for every €3 to be contributed by the state, how or will this affect existing company pensions and AVCs?
Okay, that's a really good question, and thank you for the question. Let me show you an example of how auto enrolment will work. So, for example, let's say that somebody's earning 40,000 a year. In the first 3 years, there's an obligation on the employee to pay 1.5%, on the employer 1.5%, and the state's going to be 1%, which will contribute up to the obviously €1,400 on the table there. And then it's going to increase in year 4 to 3%, in year 7 to 4.5%, and in year 10, which is going to be at 6%. If you're an existing employee with a company contribution of at least 1.5%, then this won't affect you. However, there is a stipulation whereby, let's say your company pays in 3% of your salary into a pension, or indeed 5%, they're going to fall foul of those contributions in future years. And it's an opportunity for you to essentially have the conversation with your company in relation to getting up to that 6% matching level, albeit it may take 9 years for that to occur. And what I'm really trying to do is empower employees to understand that there is a conversation to be had. If you're already in a fairly generous pension arrangement, then yes, it doesn't really affect you. But the reality is that, as I said earlier, for those that aren't a member of a company pension plan, they really need to take advantage. We understand this is going to affect about 550,000 to 600,000 lower tax rate payers, but also around 200,000 higher tax rate payers. Now, I'm not in favor of the auto-enrolled scheme, and I'll explain why a bit later on, but there are some, I suppose, advantages. One is, for example, that for any companies, you can hopefully be able to attract new staff by the fact that you are offering a pension scheme. You can also possibly retain people, and that's part of the argument why the government are doing this. They want to have more pension coverage, obviously, for everyone in Ireland, but also as an employee myself, having a company pension arrangement does, I suppose, somewhat engender some loyalty. The key things to remember are, if you're paid more than 20,000 a year, you're eligible under auto enrolment. If you're paid less than that, you're not. And if you're aged between 23 and 60, they're the criteria that qualify for this scheme to operate. You might say, Nick, okay, what about the state pension? Will this be affected? No, you are going to be entitled to the state pension, either the contributory state pension, which is based on working for 10 full years in Ireland, which is 520 months of PRSI contributions. And we actually have, as much as I berate the Irish government for various things that they don't provide, The Irish state pension is actually quite attractive. It's about 14,500 a year based on those 10 years of contributions. However, it won't be enough for people to typically live on. The current weekly rate is about 277 euros. In respect then of what would you need to do? Well, as an employer, you may have a company pension scheme, but if you don't have all of your employees signed up to the scheme, because some employees may not have joined the pension scheme, and we're coming across more and more companies where there isn't 100% coverage. You need to think about creating another layer of pension contribution in line with the auto enrollment rate of 1.5%, but you can essentially allow your employee not to have to pay into the scheme, which would give you more flexibility and obviously maybe more suited to that employee. If they're 23 years of age, they may not want 1.5% of their salary deducted to go into a pension scheme. And what I'm trying to say here is that it does give the employer a little bit more wherewithal to ensure that they're not paying two pension contributions, one to their existing pension provider and the other to the government body. The government body is going to be massively bureaucratic. You can only imagine the massive, I suppose, backlog and administration issues that are going to face. And I certainly wouldn't be encouraging any employer to want to get anywhere near that. If there's any high rate taxpayers, auto enrollment only provides relief at a 25% rate. However, if you're in a company pension scheme, you get relief at 40%. It's much more attractive. I mentioned about new joiners. Obviously, those that haven't joined the pension, you can create a separate subcategory for them. And it's really about giving advice. And the key thing about pensions is I do think advice is important. So, as I said, what are the differences between an existing scheme and auto enrollment? Just to summarize, no access to the state auto enrolled scheme before the state pension age. You can't make additional contributions. It's really inflexible. There's no AVCs in auto enrollment. That's the additional voluntary contributions. There's no advice given. Alpha Wealth provide advice to any company pension schemes that we manage. We manage a number of pension schemes ranging in sizes of over 500 plus employees down to a one-man scheme, one-person scheme, I should say. There's no investment choice in auto enrollment, where there is obviously in relation to the traditional company pension or PRSA route. On top of that, I went through some example of the contribution rates. It does give people an opportunity really to start thinking about their long-term savings and helping them to essentially reach financial independence early. However, it's not going to be enough on its own. And I talk about balancing in respect of ensuring that you are meeting your objectives in both the long term, but also the short and medium term. And part of what we do in Alpha Wealth is helping people find the right balance. I talk about dials and ensuring that you're putting enough into each pot, regardless, of I suppose what you're forced to, based on what your financial situation allows for and what criteria you have. There's no point me suggesting that people put all their money into a pension scheme when they've got requirements to say buy a property or buy a car in the near future. And this compartmentalization that I refer to, short, medium, long term, short term being anything from 0 to 3 years, there are definitely opportunities for us all to take advantage of generally attractive interest rates that are available now. We were so used to, for so long, getting no interest from the banks that a lot of us just became kind of, I suppose, inert when it came to getting our money working for us. And what I'm saying to people constantly is you can take advantage of very good rates over that short-term period. Anyone, in my opinion, should be saving for something later they're doing this year or next year. Put it into an online account with AIB Bank of Ireland and get 3% gross on that. The other option then is for lump sums. If you have money sitting in your current account, think about setting up an account with one of the online banks, such as Trade Republic or indeed Raisin. These are the banks, German origin, that will pay you somewhere around 4% for your money on instant access. And whilst some of you may not have heard of Trade Republic, one of the takeaways today is to say, well, either contact us and we'd be more than happy to give you some guidance and advice. But certainly for me, it's definitely a good opportunity. Rather than keeping money in your current account or in a low interest deposit, would you not consider maybe setting up an account with Trade Republic? You can put anything from €1 up to 50,000 into it. avail of that 4% rate, and you can transfer the money back and forth to your current account. It's very similar to Revolut. I call it Revolut on speed, in that we all got so familiar with Revolut, none of us knew where it came from, but yet we became comfortable with it, and it's the same with these German banks. In relation to then medium-term savings, I talk about this kind of 3 to 20 plus year segue. This is relevant for anyone who has children and is looking to save for their children's third level education needs, like myself. I'm 50 with 4 kids in a blended family. Also, people that may be wanting to save towards buying a house, a new house, a bigger house, their first home. And we're trying to help people focus on the fact that there are accounts. As an independent brokerage, we favor one account in Zurich called the Easy Access account. It allows full access to your money. You benefit from returns typically of about 5 to 6% a year. You can put in lump sums, monthly contributions. You can do it in your children's names, and you have complete availability of the money to stop, reduce, or withdraw monies with no penalty. And it certainly is about trying to beat inflation. Again, if anyone does have any questions and you would like to ask, please do feel free to ask them. I spoke earlier about helping our clients to retire early. And for a lot of people on this call, what David and myself do is we show projections based on your current position. So for example, whether you're in your 30s, 40s, 50s, 60s, or however old you are, what does that look like for you? I'm 50. I've set my projection out to age 63 based on my youngest child's age of independence, which I've set at 21. And the point being is that I have a goal. And for most people, I would suggest that 800,000 accumulated doesn't just have to be in a pension. It could be made up of other assets like a property that you may have that you rent, or indeed a pension fund. And arguably you can include the state pension, which is worth up to about 250,000 based on a reasonable expectation of living about 15 years after 66. But the point I'm making is that if you had a fund of that figure, you would be entitled to basically draw about 25% of it tax-free, which is 200,000, and of the remainder 600,000, that will provide an income of about 48,000 a year to you. If you didn't include the state pension, obviously that brings you north of 60,000 a year. If you did, in my opinion, that still would be sufficient for most of us, bearing in mind that we've got 200,000 to actually supplement that to live reasonably comfortably. When I mentioned this previously in one of the webinars, people challenged me on where did the 48,000 a year come from. If you put into your calculator 600,000 at an 8% drawdown rate, that's 48,000 a year. Now people question, how can you take 8% of a fund and expect it to last for your life expectancy? And the reason for that is that that 600,000 euros will continue to grow post-retirement from your 60th birthday onwards, 55th, 65th birthday, whenever you decide to draw that down. And what we're trying to do in Alpha Wealth is help people understand what can you do to improve that figure? What can you do to reduce your retirement age? And where are you currently? Because a lot of people probably have more money in their pensions than they realize because of the compounding growth. However, they need to be managed. And a lot of us have worked in previous companies where we had a pension scheme and we just forgot about it. And the key message that David and myself are given to people is to say, well, you really need somebody to help you review that. We do that for them without any drama. It's very simple, and help them make the most out of their pension scheme. The one drawback of the state pension, and indeed the auto-enrolled pension scheme, is that it's only available from 66. And certainly for a lot of us, I think that's too late. I think for a lot of us, what we're looking to try and do now is phase ourselves into retirement where you can access some of your pension money early and work lesser hours, maybe changing your employment type to maybe something you enjoy, or stop working overtime and so on. One of
Sorry,
the other key...
Sorry to
Sorry,
interrupt
Ruth.
you there. Just we're getting a few questions in there. Someone just wrote in asking, how realistic is it to retire before 60?
If you get to 800,000, absolutely realistic. I mean, as I said, I think for most of us, as I said, I can show anybody based on what ability you have to put money into your pension scheme,
Yeah.
that it's very doable. It depends really on obviously certain circumstances, but in my professional opinion, if you get to a situation of having all debts paid off, 48,000 a year of this passive income, again made up of pension, possibly property, with a 200,000 tax-free lump sum in the bank, I do believe that this should sustain a suitable lifestyle. You just have to put more money into your pension scheme. Typically, pensions are really attractive vehicles. Again, I can help people independently to understand the limits that they have, which are very generous, by the way. A lot of people ask me, Nick, how much should you put into your pension scheme? And my general rule of thumb is a minimum of 5% of your gross earnings. If you're earning 50,000 a year, 5,000 a year of that should go into your pension. People might think that's a lot of money. That's 416 euros a month. But the fact is you get 40% tax relief. It costs you 250 euros a month. I don't think that's a lot of money in order to have a good lifestyle from 60th years onwards. Some people may have worked in the UK for 3 years or more. Another massive takeaway from today is if that includes you, which it did me, you should absolutely look to buy back cheap UK state pension years. I did it myself recently, and I'd like to be able to help people understand. Some pension advisors are charging somewhere between 1,500 and 2,000 euros to do this. And in Alpha Wealth, we just do it as part of the financial consultation that we provide. I think it's absolute robbery. One of the key things as well today, guys, is that if you have the ability to talk to your pension provider, whether it's a scheme you've set up yourself or whether it's a scheme that you're now going to be in a position to. And what I'm saying to all employees that are not part of a company pension arrangement, ask your employer, can you pick the pension provider? Because in my opinion, if I had a choice, I would pick Zurich. They are the best pension manager in Ireland. We've gone on record and said this extensively. This slide here is some evidence of that. It shows a comparative of like-for-like funds between 4 different providers, and you can see the Zurich Prisma 5 fund, which is one of our preferred funds in Zurich, which is the dark blue line, features the best over that 5-year term. And I can go back as long as people want me to. We give specific guidance around funds, whether you're in a pension scheme that you have to stay in. For example, if you work for Google, you have to be in an Irish Life pension scheme and so on. But the point is that there are variations of different funds. Key things for any employees that are listening, and if you already have a company pension scheme, now is a really good opportunity to not only think about the number of people that are in your pension and obviously ensuring that you have 100% participation, but also what fees are you paying? I've come across companies over the last number of months where they're paying like a 5% contribution rate. It means that only 95% of what their members are putting into the pension is actually invested. You should be getting 100%. There's no reason for any broker to take 5% of those payments. In terms of management fees, again, it's really important to watch out for. And I'm really, really conscious of the fact that a lot of companies are paying way too much in fees. And obviously they're losing out then on fund performance. And this constant review process that I talk about, I think is really, really key. I
Sorry,
just
Nick,
want to show you.
just to jump in one
Sorry,
more
Ruth,
time, someone just asked another question around company pension scheme. So it says, my company has a pension scheme, but I haven't opted in yet. Do you advise I enroll with my company pension or allow for auto enrollment?
Definitely not to allow yourself to roll for auto enrollment. If there's one key thing that I want to explain to people today is auto enrollment is a disaster for a number of reasons. One is that you can only put in 1.5% of your salary. The company will only put in 1.5%. If you've got the option of joining the company pension scheme, they're probably offering you north of that, 5%. So you're giving up free money. The other thing is that you're going to get no advice on an auto-enrolled scheme. There's no choice of provider. And some of the providers the government will choose will underperform. You can't access the auto-enrolled scheme until 66. Why would you want to put yourself in that position? If you join your company pension, you can access it from the age of 50 if you leave the company before 50, and earlier than 66 if you leave the company before 66 years of age. These are the issues on the screen here as to auto-enrollment. It's the expense. You may be able to pay in less money into a company scheme. It's inflexible. There's no early access. If you're a high rate taxpayer, it's a disaster. You're missing out on 15% tax relief. And the administrative hassle for the company, but also for the member, is absolutely something that you try to avoid. I just want to show you 3 very quick examples of how you can reach financial independence at 60 or earlier. 25-year-old, for example, who's in a well-paid position. Some people are at that age being paid reasonably well, joining a tech company, pharma company, whatever. if they're a high rate taxpayer, they could put €1,000 a month into their pension scheme at a standing start and get to that 800,000 figure at 50 and retire. You might think €1,000 a month is unrealistic, but what if their company's paying half of that? And therefore, the other half, the €500, is costing them €300 because the taxman gives them back €200 a month. I don't think that's unrealistic. And again, this is an average. And there might be reasons why it's extended. Maybe they take time off work, go traveling, buy a really expensive property. That means that they can't put that 300 quid a month into a pension scheme. But in general, I think this is really doable. If you're slightly older, let's say 35, and I make one assumption here that this person has 100,000 of a pension pot, their contributions have to be slightly higher. Now, again, I've extended the age that they draw this down at 55. That's 1,100 a month, again, with a slight increase in cost to them of 360 net. And if you're 45 years of age, I've pushed the retirement age out to 60, assuming that they had a pot of about 200,000. And again, we make these figures specific for each individual that we talk to. And I would suggest to all of you that you'd have an idea about where your trajectory is bringing you to. And this can be varied. And the key thing is that it's reviewed once a year. But this particular individual would need to put in about 510 a month to get to the same point at a slightly older age. I hope that all makes sense. And again, if anyone has any queries, please do feel free to pop them into the chat. One of the other things that I've spoken to companies about recently are other benefits. Now, I appreciate that auto enrollment's coming at a bad time for a lot of companies. You know, we've seen the minimum wage increase. We've seen companies, and if you think about hospitality, particularly, if let's say, you know, there's a business that has 20, 30, 50, 100 employees, all of them will have to go into a pension scheme of some description, preferably a scheme that they choose, because then they can alleviate the cost of the employee, because the employee's not going to really thank the company if there's 1.5% of their salary being deducted, even though this is through the government, and they can avoid that. But that you can try and mitigate the increased future costs. You don't have to go up by the 1.5% every 3 years. And as well as that, I think there's a lot of argument about the outperformance of the company pension schemes over the auto-enrolled ones. But the company can also make a decision at this time to think about, okay, are there any other benefits that we can provide that are going to be more of a, I suppose, a market leader for us? You know, what's going to differentiate us from every other company? Now, again, while I'm loath to add any further costs to companies, I'm all about trying to give information and help company owners make more informed choices. So, for example, death in service is a relatively low cost benefit for companies, particularly if you're a relatively small company, because what you can do is you can introduce for all of the staff or for a small cohort of the staff members, say for managers or whatever category the company wants to choose, where you can provide benefits such as death in service, i.e. like 2 or 4 times salary if the member passes, or indeed income protection where a certain percentage of their income is insured. And the rationale for this is that because you're treated as a group and there just needs to be 3 members to form a group, you get massive discounts. It's about 25% of the cost if you were to try and buy this policy personally. There's no medical requirements and there's great flexibility and there's no medical forms at all. So let's say, for example, like as a business owner myself, rather than me paying for life assurance for my family, I can introduce a death in service scheme, get 4 times my salary covered. I can include 2 or 3 members of my staff, and I know that I'm paying less for that than I was for my personal policy, and the company's picking up the bill. It makes a lot of sense for people, and especially for any business owners listening, to think about themselves and, as I said, for either a cohort of staff or get a cost in for what this would cost. I'm all about getting information and then making a decision whether or not that's something that you want to introduce. That's a separate decision to make. So just to kind of finish off, what are the next steps? We try and suggest to people that whilst sometimes there's so much noise and there's so much being spoken about auto enrollment at the moment, I hope I've given a kind of a clear direction as to why I do think it's important for employees who are not part of a pension, or indeed employers that don't have 100% participation in their pension scheme, to get on the front foot and look at the option as to what they can do, either creating this separate category for those members that don't want to join the pension, or indeed looking at their current pension arrangements and saying, okay, can we do better? I've mentioned Zurich, I've mentioned the 100% allocation, I've mentioned getting advice around fees. What we do is we provide a very simple spreadsheet. It's all encrypted, fully obviously confidential, where we suggest that if you provide us some details of the employees, we can give you a costing based on what that would look like and help you understand and reduce the costs to both yourselves and to your members, and ensure that you have the best options presented. And as I said, as independent brokers, we're happy to use various providers. No obligation to go ahead with that, but it's more about making sure that you understand what's available. I mentioned earlier in the webinar about the next webinar that David's doing, my colleague. He's going to talk about how to minimize tax and to retain wealth. It's a really interesting 30-minute complimentary webinar that he's running on Thursday, the 18th of April. And I would encourage anybody to register for that. You can do it either through our website, and I think my colleague Ruth is going to put it up, or Kerry will, on the chat function for you to sign up. You can sign up for all future webinars in Alpha Wealth, and we do record them, and obviously you can play them back in your own time. We will provide this recording for any people that have joined or registered, just because we find it very useful, and if there's things that you'd like to kind of listen back to. Just in terms of the, I suppose, the results of the poll, I see that there's 30% of people that aren't a member of a company pension scheme. So I hope that's helped perhaps yourselves. And even if you are, I think it's a good opportunity for people to just take stock of where they are. I spoke about, making sure that you are, I suppose, reviewing your own arrangements. I've spoken about, this projection. I've talked a little bit about making the most of your money, not only in the long term, but also short and medium term. And as I said, we're more than happy to provide any guidance and advice to anyone who's operating in Ireland. The last thing is just to say that we provide, myself and David, a 1-hour financial consultation where we give you specific advice. We put together a spreadsheet based on your present scenario, tabulated for various different financial plans, from protection policies to savings accounts to your pensions. We review any legacy pension schemes. We help you understand that. We get you details around, what type of vehicles make the most sense to you in an independent way. The cost typically is 199 euros. It's a once-off fee, and we are reducing that down to 99 euros until the end of April for any appointments that are booked that are essentially done before the end of May. And if anyone would like to book a financial review, again, we will provide the details at the end of this webinar, but you can do it through our website, alphawealth.ie, and indeed through the links that are provided. If anyone, however, does have questions, or if you want to book a complimentary review with David and myself to discuss auto enrollment and how it might affect you as an employee or your company, if you are a company owner, the consultation fee is waived. Just please feel free to reach out to us and just make reference to that. The code, by the way, for the 50% discounted consultation is 50 alpha. That's 50 and then alpha, obviously, in all caps.